The time has finally come. In his clearest indication yet, the US Federal Reserve Chairman, Jerome Powell, has signaled that the American Central Bank will finally start cutting interest rates. The markets are now estimating that the monetary policy easing cycle could potentially begin as early as September. In a much-anticipated speech at the Jackson Hole Symposium, which is the Fed's annual economic conference, Jerome Powell said that the risks of inflation rising have eased, but the risks to jobs have increased slightly. The Fed chair also emphasized that it's time for the monetary policy to change, but the timing of the rate cuts will be based on incoming economic data. The US markets reacted extremely positively to this news. The key Wall Street indices, the S&P 500, the Nasdaq Composite, and the Dow Jones all jumped over 1% on August 23 following the Fed chair's speech. The markets are pricing in around a 60% chance of a 25 basis point cut in September. On the other hand, around 40% of the market participants believe that there will be a cut of around 50 basis points in the September meet. The Federal Reserve kicked off its rate hike cycle in March 2022 when inflation in America was around 8%. The Fed funds rate at that time was between the 0.25 to the 0.5% level. The Fed then raised its funds rate systematically to tackle rising inflation, finally taking the rate to about 5.25 to 5.5% in July 2023. Thereafter, it has kept its rates unchanged, completely steady for about a year. This is in an attempt to get inflation closer to the Fed's targeted rate of about 2%. So what does this mean for Indian markets? Well, according to some experts, expectations of a quicker rate cut could positively impact Indian capital markets. This could accelerate FII flows, which have been muted thus far. Any cut by the US Federal Reserve also means that the RBI has further room to consider easing rates in India, which will also positively impact economic and equities growth. So the consensus is that Indian equities will outperform thanks to two key reasons. First, the return of foreign investors, which will prop up the domestic markets and raise stock prices. And the second, a lowering of interest rates, which will then drastically reduce borrowing costs for corporates, as well as spur spending, both of which combined will support growth. So overall, it seems that Christmas is here before it's actually here.